All right, ladies and gentlemen, here I've got the Twitter trade, the $1 Twitter trade. If you remember me talking about that a few days back, and I'm actually at work, so if you hear music in the background, we're actually at a martial arts school. I'm in the office right now recording this, so they're doing a class right now out there. So Twitter trade. Hopefully you can see everything on my screen here. Let me go through something real quick on chart charts. If you're a member, we have this live spreadsheet that we put all of our trades on. If you look down here at the bottom tab, this is all the team trades, and then I've got my open trades I also put on the sheet. So if you go over to that tab, it'll have just these goofy trades that I did. So if you look, I've got 20 wins, 2 losses. If you look at the amount spent on each trade, we've got a 591% average return and have a win rate of 91% on these so far. So they move slower. A lot of them might be time decay plays. It'll have a wide range. It's a slower moving trade, but high probability then. So I kind of like those. You don't have to babysit them. I don't sit around and stress out about markets going up or down. I don't really care that much. Some of these will be directional. Some of them won't. The CMI and Halliburton and Coles, those aren't really directional trades. If they just stay right in the middle, it's just time decay. And so let me show you the Twitter trade. It is directional, but it's kind of a cool setup. So it seems kind of complicated at first, but I'll break all this down. It's not that bad actually. It's just 3 different. If you do a single contract at a time, if you look at it that way, just go slow. It's pretty easy to understand. So most of you are probably familiar with buying puts, buying calls. That's pretty easy. When you start getting into selling it, if you've done vertical debit spreads, it's not any different than that. I'm just changing the expiration date here is all. And this is actually more like a credit spread. So here's what I'm doing. I'm selling the October 26th 28 put for 194. Okay. I also like to put in my open interest date delta on all these strikes. Okay. Collecting 194 on that. Now I need to hedge that. I don't want to be doing naked puts. I don't want to own the stock at 28 a share, 100 shares of it. So I want to hedge that. I'm going to buy the 25 put, but here's the thing. I'm not doing the same expiration. Okay. If you do the same expiration on these two things, if it gets down to 25, you're going to be at max loss. Now, for the purposes of this video, I did 2 contracts of these, so my max loss would be 300 times 2. It'd be $600 max loss if it got down to $25 a share if I did the same expiration. By doing the different expirations, you're kind of changing up your time decay is going to be different. The way they trade together is going to be a little bit different. Okay, so that's my hedge. I bought that for 102. That leaves me some extra spending green here. Okay, so what I did was I bought the December 21st 34 call. That's an out of money call at 93. Okay, that makes this trade my cost total of $1 in the actual trade. Okay, it is going to reduce your buying power by $300 for a single, per contract because of the difference between these two. But I'll show you. It's not really, even if it hits 25, you're not losing $300. Okay. Our profit target is at least a couple $100 on this. Here's the trick here. Here's what I'm planning on doing with this. Earnings is October 25th before market open. So that means on the 24th, I don't really want to be holding this still. So I want to close this out on the 24th or sooner if it pops. Okay. So let's get back over the chart here. So I really think 30s are a real possibility to go from here into earnings because we usually have a little bit of a run up. If we hit 30 before that, I'd be very happy. So let's go to analyze tab. Okay, now the $300 loss. Remember, I have 2 contracts on this, so mine would be 600, but still, it is way down here at $19 a share. If you see where that is, way down here. That's not likely, but it's possible. More than likely, it's going to kind of hold this area between now and then, especially with the market drop here this week or this past week. That's actually been holding still, and that's actually the support line too. So I kind of like that setup. American Express is another that's kind of interesting to me on that front. So yeah, there's your max loss. So if we get down to $25, remember on doing same expiration, you're at max loss. This one you're only at 260 loss, which is actually that's for 2 contracts, so it'd be only 130 loss. So it cuts your loss in half by doing a different expiration. So that's pretty interesting. So here's our current price. We are traded right here on the 24th. Let's say this thing does nothing between now and then. Look at the purple number down here in the bottom left. That means it is worth 147. That is if you're closing everything out. Here's what I actually want to do, because I have the November 16th put and the December 21st call. Is I want to buy back this October 26th, 28th put just prior to earnings, like on the 24th. So I put the day in here, the 24th, that purple line. I'm hoping that we hit 30. So I should be able to buy that back then. Here's how we know what's that going to be worth. I put Cleo price in here. We're at 10.24. If it jumps up $1.55, if you look at your implied move, entirely possible. We may go way higher than that. So if we hit 30 on that 28 foot Cleo price here, it's only going to be worth 15. Remember, we sold that for like 190 something. So that basically is going to pay for us to hold the other two options here. So now I basically have a free earnings trade. So I'll hold that put and I'll hold that call through earnings then. And at that point, I've probably got, you know, not much in that trade. You know, $16 or something is what I'll have in that trade. If that does go up to like the implied move, gosh, that'd be another $2 or something on top of that. Yeah, then I mean you're talking the thing's gonna be worth $2 then. Okay, so yeah, that'd be a nice trade. So target on 10.24 though, I mean that thing should be worth $275 for 2 contracts. So we're talking like $135 a contract. Remember, you've got $1 in. You technically have $300 risk, but like I showed you before, you know, even all the way down here, even down to 25, you're only $130 risk. So the risk reward is nice. This is the graph for according to October 26th though expiration. This isn't really factoring in the fact that I buy that back and now I'm holding these other two that are paid for that. Okay, so that'll be a nice setup then. You'll have a nice free trade at the end of that. So if you have any questions, let me know. But that should be about it.